How important are dividends to the long-term performance? Extremely important, relatively important, not very important, completely irrelevant. So 50% of the room are over 60, because we know that it's really important. Anyway, look, it's my pleasure to introduce a DJ Shavrum from Fidelity. DJ's been a portfolio manager at Fidelity since 2008, a great year to start, as I said to him. He's been running a dividend policy for the last 4 years. Now, just to sort of give you an indication of how old we're getting around the world, dividend factored funds have grown from about $130 billion some 4 years ago to over $257 billion today. So there's been a massive rise in the number of dividend based or factor funds, and so I welcome a DJ just to outline in his presentation where he thinks we might go with these dividend funds.
Thank you very much, John, and thank you all for the opportunity to present to you. So, as John said, I'm a dividend portfolio manager, and I just wanted to spend the time today really to talk through a couple of things. One is just highlight, I think John encapsulated massive growth in funds going into dividend strategies, which has been great, personally. But I think it's a very, very good time to take stock of sort of where we are with these dividend strategies, because I think to be dogmatic about specific strategies through all periods of time, I think leads to a lot of mistakes, especially investment mistakes. So what I'm hoping to do is really talk through sort of why dividend strategies have been so popular, why they're so popular right now, but really try and focus the presentation on what I see as sort of the three big concerns I have with high dividend yield strategies at this point in time of the market, at this point in time in the profit cycle. So I'm hoping I can share that with you, and then perhaps also offer an alternative dividend type strategy, a more sustainable dividend type strategy that I think is more compelling given where we are in the cycle. So I think this is, I think as previous presentations always will produce something on that Albert Einstein has said, so do we. But the point here really is the power of compounding over long periods of time. So if we look at very long periods of time, so this is the Elroy Dimson study that's done over 114 years of the US stock market. The annualized real capital return, excluding dividends, was approximately just shy of 2%, and including dividends is just north of 6%. So the 51 or 52% of you answered, who said, how important is it? It's pretty important. The real value of these dividends actually come from the compounding, from the reinvestment of these dividends. So that's what really gives you the kicker, and that's really why dividends matter over long periods of time. A slightly shorter, over a shorter period of time. So this looks at dividends over the last 45 odd years. And what it does actually, it decomposes the real total return across different markets. So the UK, the US, Australia as well. It decomposes the real total return by dividend yield, dividend growth, and PE, multiple expansion, PE expansion or PE contraction. So the numbers you see, the numbers in black you see is the real total return for each of those markets on an annualized basis. and the blue bar is the contribution to that coming from your dividend yield. So again, illustrating over half your real total return over long periods of time come through your dividends. So dividends do matter, and it's sort of irrespective of geography and irrespective of time period. If you had chosen it 65 versus 75 or 80, it would look roughly similar. So over long periods of time, dividends matter. Why have we seen such a huge inflow into dividends in the last 5 years? The reason we've seen such a huge inflow is really illustrated here. So the clear bars show you the yield you could get across asset classes pre-crisis, and the shaded bars show you the yield you get across those same asset classes today. And what you can see pretty obviously is you've seen massive yield compression across all asset classes. The only asset class where you haven't seen yield compression relative to pre-crisis is on the equity side. So dividend yields are at pretty much at or where they were pre-crisis, and that's one of the reasons why you've seen this big flow into dividends, in that search for yield, or the hunt for yield, if you will. But I think looking at it this way, there's sort of something fundamentally wrong about making comparisons across different asset classes. And I think when you look at these asset classes, they're actually inherently incredibly different. So cash and the right kind of government bonds have very little drawdown or no drawdown at all. High yield and equities have much, much higher drawdown. So I don't think you can compare. These are not really comparable asset classes. So if we do look at two asset classes that are more comparable, I think high yield, high quality equity share a lot of common characteristics. They're sort of much further down on the capital structure, so they're sort of more equity-like. High yield is more equity-like. Quality equity is more high yield-like. And actually, the drawdowns, high yield versus quality equity, are actually fairly similar in down cycles. So if we look at sort of high yield versus equity, this slide really illustrates sort of where we are and why you're seeing a flow of funds from high yield into equity right now. So the spread, if you will, or the yield gap that you get, that high yield offers versus equity. So the historical yield spread is approximately 5%. So it's a 5 percentage point increase to your dividend yield. That's been your 25-year average that high yield has to give you to own that versus the dividend yield of the market. Today, that yield spread is just 2.5%. So really showing sort of how at least relative to equities, how expensive high yield bonds are. So, and I think that's been part of the reason why you've seen a flow of funds into the dividend side. So I guess, so why am I concerned? So sort of, what am I concerned about? You have equities looking attractive relative to high yield, equities looking attractive relative to any other asset class. What really am I concerned about? I think before I get into this, sort of three things I am concerned about. I think one thing, I just as a word of caution, I just want to point out, sort of looking at things, relative value investing is sort of, in fact, the word relative in investing can be insanely dangerous, because you can justify almost any rationalization of an investment by comparing it to a pool of assets or a pool of something else that's much, much poorer. So relatively, it looks very good, and you say, okay, relative to that, it's a good investment. I'm going to go at investment. That's actually usually a huge mistake. I mean, it's not dissimilar. Sort of, I can very easily say, sort of relative to my friends, I'm a good golfer, but sort of on an absolute basis, I'm pretty lousy. So, and I think that's the danger with relative. So to compare equities versus a risk-free rate, I think is just not the right comparison, because the drawdowns are completely different. I think what's more applicable is try and compare equities to equities, or compare high yield versus the broader market, and that's what we're trying to do over the next few slides. So let's look at sort of more apples to apples comparison in terms of valuation. And I think my first concern for high dividend yield strategies right now is that high dividend yield strategies are expensive. So the starting valuations today are high. In part, you've seen the flow of funds going into high dividend yield strategies, and I think these have bid up a lot of the high dividend yield stocks. But I think this just illustrates. So usually the high dividend, so we have the MSCI World High Dividend Yield Index. The P of the MSCI World High Dividend Yield Index typically trades at a 15 to 20% discount to the broader index. There are low growth stocks, typically they attach a lower P multiple to it. Today they trade at 106% of the broader market. They're actually significantly more expensive and close to being the most expensive they've been in the last 20 years. I think that's one key concern I have. These are companies that don't have significant growth or significant growth outlooks, but they're trading at a significant at a multiple premium to their own relative history. And I think that's a word of caution, because starting valuations really do matter to total return. And I think the classic example of why starting valuations matter, sort of a good case example, I think you've seen this before. Walmart, 2001 to 2011, 10 years, they tripled their earnings from $1.60 to $4.60. Starting valuation was in the 30s. Ending valuation was it ended at about 12 times earnings in 2011. Your total return over that period was a measly 16% over a 10-year period, even though you had this huge earnings growth. I think it really illustrates starting valuations in investing really do matter. And I think the starting valuations for high dividend yield stocks today are quite expensive compared to their own history. The other big concern that I have from a high dividend yield standpoint right now is very often high dividend yields can be a sign of stress, usually a sign of distress with the operating fundamentals of the business. And what you see, the analysis that you see is when you go over a 6% dividend yield, what you expect to get from your dividend, so the expected dividend yield versus what you actually realize, are quite different. In fact, the higher you go, the higher the yield goes, the bigger the divergence as well. And classic examples of these are the European financials in 2007, 2008, the US financials over the same period as well. And I think I included a telecom stock as an example because we all view telecom stocks. These are safe businesses. They're relatively acyclical, if you will. They shouldn't be immune. They should be immune to significant dividend cuts. But in 2012 and 2013, every single European telco cut their dividend. The most egregious of these was Telecom Italia, the incumbent Italian telco. In fact, over an 8-month period, they had the starting dividend yield was north of 7%. They ended up they cut their dividend zero, so it was a 0% dividend yield. Why? Very heavily indebted company, very high payout ratios. They had a few regulatory headwinds, and they had intense price competition within their market. The profitability didn't match their dividend payment. They had to cut it in half, and then they cut it to zero. And I think it's an illustration that the high yields that you can see in the market can be very illusory. Now, unfortunately, a dividend cut is not just a dividend cut. It's not an erosion of your expected total return from the dividend. When a company cuts a dividend, you get a double whammy. The dividend gets cut and the stock gets hammered as well, and it takes much longer for you to recover that loss of capital. So I think that's the second concern I have with high dividend yield strategies right now. The third concern, and I think this is, if there's one big takeaway right now, I would say the third concern is what's top of my mind, and that's the fact that corporate profitability is at all-time highs today. Why is corporate profitability at all-time highs? Corporate profitability is at all-time highs because interest rates are at all-time lows, effective tax rates are at all-time lows, and labor share of GDP is at all-time lows. So if you look at a company's P&L, you have revenues, costs, interest expense, tax, and then what shareholders get. Your costs are at all-time lows. Labor share of GDP are at lows. Interest rates are at all-time lows. Your interest expense, you've refinanced a lot of your debt, they're at all-time lows, and effective tax rates are at lows as well. So your corporate profitability is at all-time highs. And I think these tailwinds mean reverting over long periods of time, and I think these tailwinds have largely run out. So, at this point in time in the cycle, I think cyclical companies with high debt especially and high dividend yields look very, very vulnerable. A great example of a company stuck in that was, pick any bank in the any non-Aussie bank in the financial crisis. Actually, any non-Aussie and non-Canadian bank in the financial crisis. These are banks. So Royal Bank of Scotland is the one I picked. The ROEs went from 8% to 16%. 16% ROE, Royal Bank of Scotland had never seen in their existence. So they were massively over-earning in terms of profits. You had the financial crisis, and sort of, the dividend didn't just go to zero, but you had basically a permanent loss of capital, which is what you absolutely don't want in terms of investing. I think this is an example where you have, I would say, sort of high cyclicality, high indebtedness, high payout ratios, and if you have some kind of chink to that corporate profitability, you're at very, very severe risk of not just forget about losing the dividend, but losing permanent capital, and that's not recoverable. So that's probably the biggest fear I have right now with high dividend yield strategies, because a lot of the so interesting question, where is the high yield today in the market? The high yield in the market today is in financials, it's in energy. These are cyclical industries. Being cyclical industries, they have high payout ratios as well. They have low growth. So I think they have high indebtedness as well. So that's what makes me doubly worried with high dividend yield strategies. So what am I really concerned about? Expensive defensives. We talked about high yields can be sign of stress. So what you expect is illusory, and compared to what you actually get. And probably most relevant to where we are in the market cycle right now, given corporate profitability is at all-time highs, a company's profits and dividends may not be sustainable, and you could get, especially if they're cyclical and indebted, and you could get a permanent loss of capital. Forget about the dividend. So, I think of these three risks, I would say the corporate profitability is what concerns me the most right now, because I think a lot of people talk about PE multiples being normal. They're sort of in line. Maybe they're slightly elevated, but sort of roughly in line. But I think what is not in line is where corporate profitability is. So what does that mean as a dividend-based investor? Should we sort of abandon all dividend-based strategies? And I think I wanted to offer a more sustainable solution and sort of steal something from the US. So the US has an index called the Dividend Aristocrats. I'm sure many of you have heard of it, and it's basically a subcomponent of the S&P 500. And these are companies that have consecutively increased their dividend each year for the last 25 years. That's a pretty high bar. That's a pretty high bar to cross. So the number of companies that can constitute this index is around 52 companies today. But the bar itself is relevant. But I think when you dig into the numbers, these companies have some incredibly attractive business characteristics. They have a higher ROE than the broader market, so they're higher quality companies. They have a lot less indebtedness than the broader market because they're higher return companies. They don't have to go out to the debt markets to grow. They have a slightly higher dividend yield, 2.5% versus 2% for the broader index. But more importantly, they have higher growth right now versus the index. So. I think they have a lot of very interesting operating characteristics that certainly appeal to me at this point in the cycle. Higher return companies, less cyclical businesses with lower financial leverage. I think going forward is to me is a better place to be given where corporate profitability is. But it's not just the operating characteristics that are attractive. if you look at the performance characteristics of the S&P Dividend Aristocrats, they're quite impressive. So the annualized 10-year returns are higher than the S&P 500. But if you look at the bars on the right-hand side, the volatility of these returns are actually lower than that of the index. And I think that combination is very, very compelling. So, you have higher returns with low volatility, sort of risk-adjusted. It's a very, very attractive returns. And then if you add on what I'd sort of mentioned before about these are higher return companies, they have lower debt, lower debt and lower downside, I think that makes for a more compelling opportunity. So these are, this is the S&P, the S&P Dividend Aristocrats. And I guess at this point, sort of, you'd ask sort of what's the catch? These, their performance characteristics are great, volatility is low, these are sort of better quality companies, they must be very expensive. And I think this is why I'm sort of talking about the Dividend Aristocrats today is, today you can buy these at sort of inline multiple to their history, their 15-year average. They're roughly trading in line to their 15-year average. So you're paying an inline multiple, if you will, right now for what I believe to be a higher quality set of companies. And I think that's why this is a more compelling dividend-based approach than the high dividend yield strategy, which is trading at a significant premium to the broader market. So I think that's really where the U.S. S&P Dividend Aristocrats. So it's very well known in the U.S. as the Dividend Aristocrats. I think though, it's given the attractions of the Dividend Aristocrats, it makes even more sense to take this global. And the reason I think it makes more sense to take this global is really what a global approach does. It sort of reduces or mitigates some of the regional market concentrations, sort of these that are quite unfavorable. So, for example, in Japan, industrials are quite a big part of the Japanese market. Industrials are inherently cyclical. In Europe, financials used to be the biggest part of the European market before the crisis. Financials are inherently cyclical. In Australia, as you know, financials sort of dominates the market, and financials are cyclical. And in fact, if you sort of split the yield out in Australia, 5 stocks give you 50% of the Australian market yield. 4 of them are banks. And please trust me, I know the Aussie banks did incredibly well in the financial crisis, but banks are cyclical and they have debt. I'm not saying that banks are necessarily super unattractive, but I think we have to be cognizant that they are cyclical and they have and their business model is based on debt. So when you have small movements on the asset prices, they're quite big movements on equity. So what going global does is I think it helps you mitigate some of these concentrations within countries, within regions, and some of these yield concentrations, especially within countries and regions. What going global also does is it sort of helps you tap into sort of better attitudes towards dividends, if you will. So, different regions have different attitudes towards dividends. So the US actually prefers buybacks, primarily for tax reasons. The UK and Australia have very strong dividend cultures. The Eurozone is very quick to raise dividends, very, very quick to cut dividends as well. And sort of Japan, sort of they don't really care about dividends, buybacks, or shareholders to a large extent necessarily. That's changing though. I think that is changing right now, but they haven't particularly cared about shareholder return per se. But so I think going global gives you can tap into markets where attitudes are more conducive to dividend growth or more conducive to the value of dividends. In fact, you see this where if you index the dividends in 2006 and through the crisis versus where they are today, sort of the US. They have low payout ratios, they favor buybacks, but they're very loath to cut their dividends, as is the UK, and you see they grow the dividends the most. the Eurozone is the one region, as I said, they're very quick to raise dividends, they're very quick to cut dividends, and you see that in terms of the compounding of dividends over that period of time. So what would a global dividend aristocrat portfolio look like? This is what it would look like in terms of performance characteristics, 5-year annualized returns, higher than the global market. And again, quite similar to the US S&P dividend aristocrats with lower volatility, so sort of more attractive risk-adjusted returns. So I think it makes for a very compelling proposition given where we are in the cycle today, given the premium attached to high dividend yield stocks. I think this is a more sustainable way to invest in dividend, getting the benefits of dividend as part of your total return, the compounding of that, without having to necessarily take excessive risk, either in terms of valuation multiples being eroded, or in terms of dividend, being exposed to dividend cuts, or in terms of being exposed to sectors you don't want to be exposed to purely because they're the higher yielding sectors. So, I mean, really, my sort of conclusion is really to encapsulate. I think there are fundamental concerns with high dividend yield strategies right now, and they leave them exposed to expensive valuations and potential dividend cuts. And I do think a more dividend aristocrat type approach, which focuses more on a sustainable yield, perhaps a much lower yield, but a more sustainable yield, can provide a much more attractive risk-adjusted total return. I think a global approach also really helps because you can mitigate a lot of the imbalances that you see from regional concentrations, either from a sector standpoint or from a yield standpoint. So that was my presentation, and I'll hand it back to John. Thank you.
Thank you very much, DJ. People, no questions yet. Come on. It's about dividends. This is what we're going to live on in the future. So if you have a question, could you please send it through using the app? DJ, one of the things that's really interesting is that Australian stocks are high dividend payers. So in your global portfolio, how many Australian stocks do you have?
0.
How disappointing for us all.
But it's 0, but it's not always been 0. I think the main point again comes back to sort of you have to look at, can you get an adequate total return from an investment, and your dividend is going to be a component of that total return. I think when valuations are high, you have sort of Australian utilities and Australian telcos trade at a significant premium to other global utilities and other global telcos. Now, part of that is, you get a lot of imputation credits. I get part of that, but part of it also is, they're fairly expensive, to me at least, from a global perspective. They look expensive, right. And I can't see a great total return right now.
So one of the questions there is, can focus on dividends be unhealthy? So do you think that the focus by the Australian investors on dividends has led to an unhealthy market in a sense?
I think being dogmatic and focusing on one factor at all points in time is just unhealthy. And independent of whether that's dividends today or growth or whatever other, low vol is a great very thematic factor right now. You focus on that. I think what you have to focus on, short answer, I think yes, definitely, it is unhealthy. Because a singular focus on dividends, I think it belies the fact, it belies a few things. One is how expensive is that? Are you getting those dividends for? How expensive is a stock for those dividends? But more importantly, it sort of belies or makes you sort of maybe shortcut into thinking that because the yield is high, the business is a good business, or the company is the profitability cycle is sustainable. And I think that's in question. In 2000, I think that's what you have to question. In 2007, the highest yielding sector in Europe were banks. And sort of that didn't end so well. A year ago, the highest yielding sector globally was energy. That's not ending that well either right now. So I think that focus on just yield is, I do believe it is unhealthy, or can be unhealthy. I think a focus on what total return can I get, what is the quality of the business that can generate sustainable cash flows to pay that dividend. That's what I would focus on, and then the dividend is a component of that total return.
Could you give some examples of those aristocrat stocks and
both
here in the US and in other jurisdictions?
Yep. So US dividend aristocrats: Johnson & Johnson, Colgate, Genuine Parts, AT&T. So those would be the classic, I guess, the classic dividend aristocrats.
And are they paying a multiple above like the other US stocks in their sector, or are they being able to sustain their dividends because their earnings power is higher?
So the payout ratios are not. It depends. So say a Johnson & Johnson, the payout ratio is not particularly high. A Colgate payout ratio is not particularly high. They're able to sustain and grow the dividend because they can reinvest back in the business and grow.
Yep.
They grow, their dividend grows as a result. There are a couple of, AT&T is slightly different. Their payout ratio is high.
So do you take a 5-year view on the growth of the dividend? So like a high yield bond that might be over a 5-year period, are you looking at your bond payout over a 5-year period and saying, well, it might be $1.20 today, but in 5 years' time it's going to be $2?
That's right. And I think that is the advantage of a dividend aristocrat is they are growing, they're growing their earnings and they're growing their dividends. And I think, as a personal investor, sort of we're trying to, our goal is, at least my goal, is to increase real, you save money, you invest because on a real basis you want more tomorrow. And that growth is going to give you the real purchasing power increase, not the yield you get today.
So if you looked at the sort of split by country of your portfolio to the market, are you overweight particular like consumer discretionary or consumer stocks?
Yeah, so I'm surprisingly I am right now overweight consumer discretionary but underweight consumer staples. And consumer staples actually are classic dividend aristocrats. They do grow their dividend.
Yep.
It's just that they're quite
expensive.
Those consumer staples are quite expensive.
So how big are the banks in the dividend index or in a universe of dividend payers?
They're in terms of the high yield index, banks actually are very low.
Yeah.
But in terms of from a yield perspective in Europe, banks are maybe 35% of the dividend yields. Australia, it's over 60. So it's they're quite significant
in different jurisdictions.
In different jurisdictions.
Now, if I was PIMCO up here, you realise the question I'd ask here is that, if corporate profitability is so fantastic, why not just buy the high yield? I'm actually getting a better yield as long as there's no defaults, right?
True.
I know they're not growing, but on an absolute return basis of 5 years, you're actually going to do okay, aren't you?
I think you could, but I think high yield relative to, I think what is clear is high yield relative to equities are expensive. The yield premium is at an all-time low, as in the yield you get from high yield versus a dividend yield is 2.5%. Historical average.
But isn't that a reflection of people's views about the profitability of companies in the markets and their ability to pay back the loan and their chances of default?
I'm not sure. No. So I actually don't think. I think it's a reflection of sort of the bunny hopping you see. The bunny hopping is cash to government bonds to corporate bonds. Corporate bonds, Nestle goes negative, you jump out of Nestle, and at the end, where are you going to land up before equities? You're going to land up in high yield, and high yield yields get compressed massively. And then as you sort of, you get a spillover into equities, into high dividend yield stocks as well.
Yep.
And then they get spilled over. I think it's more reflection of, the low spreads are more reflection of that than a huge confidence in corporate profitability.
Is there an ETF for that index that you showed us?
For the S&P, yeah.
The Aristocrat?
For the US one, there is. So there's an S&P Dividend Aristocrat. There's an index, and there are 800
ETF.
indices, 800 ETFs on it that you can choose from.
So
on a global basis, there isn't.
There isn't.
There isn't an ETF. In fact, there aren't, besides the US, there isn't an index.
So anyone wanting to start up a funds management organisation, there's a good tip for you. Are there any questions from the floor? Blimey. They're all comfortable with their dividend strategies. The design of these products, do you actually see that there's just going to be a continued demand for these types of products from the baby boomers? So as we all get older and start to draw down on our savings, are we going to put more and more money into these higher paying dividend stories?
So I think the answer is yes, because you're seeing as this sort of bunny hopping from the sort of inexorable search for yield in this insanely low interest rate environment. So I think the answer to that is yes, until you have high dividend yield stocks. It's backed by financials, backed by energy, until they break and they just can't pay their dividends because of the fundamental business. You get a permanent loss of capital, and then suddenly high dividend stocks become pariah again, and they're at a low multiple again, and then that's probably a better time to look to buy. But I think for now, yeah, I think that is where the fund flow is going.
And where do you how do you factor in buybacks into your sort of calculation of? I gave that 5-year example where the dividend's going to grow here, but you could have Johnson & Johnson buying back 2% of their stock each year as well.
Yep. So buybacks can add value. My sort of very probably incredibly cynical view is buybacks are very, very pro-cyclical. So John, the last peak of the buyback was in 2007. And no company bought back shares in 2009 at sort of literally bargain kind of prices as to when you should buy back shares. Mm-hmm. Companies buy back shares at the peak of the cycle. They buy it back at the wrong points in time. So I think
management incentives.
So I'm glad you went there, because I didn't want to be too cynical. But since you've gone there,
by all means.
Since you've gone there, I think that is basically the reason why buybacks are so prevalent. Buybacks are prevalent because if you can't find earnings growth, you're paid on EPS growth, you lower your share count. How do you lower your share count? You buy back shares, and you get your bonus, and it's management incentives, and I think that's most often value destructive as opposed to value creative.
So do you think? So let's hone in on this a little bit and behaviours. Do you think that as owners of stocks, we've been a bit loose about insisting companies have a sustainable dividend payout policy, have sustainable dividend policies, so that you're not having knee-jerk reactions to earnings, etc.?
I think that's one part is to go down that route, but that path is sort of absolving yourself of the responsibility of investing in these companies, and I guess what I'm trying to highlight is sort of it's our responsibility really to understand what's less relevant is the dividend, the number. What's more relevant is how sustainable is the company behind that dividend able to pay that on a sustainable basis. And I think the dividend yield is not a shortcut to that part of the analysis.